A transition to retirement pension allows you to access up to 10% of your superannuation tax-free after turning 60. In this video, we will explain how a TTR pension works and how you can use it to save tax while still working. We will explain this in a walkthrough case study, plus give you tips on how you can access more than 10% of your super if needed. Welcome to our Retire Well project. As a retired financial advisor, I aim to share valuable insights and practical strategies to help you make the most of your superannuation, reduce your tax burden, and achieve a comfortable and secure retirement. Let's get into how a TTR pension works. Once you turn 60, you can access your superannuation to draw between 4% and 10% of your account balance. You must nominate the desired amount at the start of your pension. With most super funds, you can elect to receive this on a fortnightly, monthly, quarterly, half-yearly or annual basis. The nominated amount you withdraw from your super is tax-free. The investment earnings on the amount you transfer into a TTR pension continue to be taxed at 15%. If you are still working and move funds into a TTR pension account, you should keep your superannuation account open so your employer can still make contributions and you can cover any insurance premiums if they are held inside super. You can generally invest into the same investments within a TTR pension that you have with your superannuation account. If you are drawing a regular income from the TTR pension, then you need to consider having liquid investment options to hold your pension payments. We will discuss investment options for superannuation pensions in another video. Once you turn 65, the investment earnings on your account balance become tax-free in the same way as a normal pension that is started on reaching retirement age at 65. A TTR pension is useful if you want to supplement your regular income as it is tax-free. You can use it for any purpose, such as paying off high-interest credit card bills or other lifestyle needs. The ability to draw the TTR pension income in one annual payment also gives you the ability to fund one-off expenses such as buying a car, funding a holiday, or supporting your children for home deposits or weddings. The obvious downside of drawing a TTR pension is that it will erode your retirement savings, so you need to take this into consideration before commencing a TTR pension. The most popular reason the majority of people use a TTR pension is to replace a part of their taxable income with the TTR pension income to save tax. If you like the idea of saving tax without reducing your take-home income, then the TTR pension can be a benefit depending on how much unused concessional contribution cap you have. The concessional contribution cap is the amount you are allowed to contribute to super each year, which is taxed at the concessional rate of 15%. If you contribute more than is allowed, it will be taxed at your marginal tax rates. For the 2024 to 25 tax year, the concessional contribution cap is $30,000. The contributions made by your employer are included in this cap amount. As the minimum contribution level is currently 11.5% for the 2024 to 2025 year, there will be no tax savings if you contribute to superannuation when your income is over $260,000, as your employer contributions would leave you with little or no concessional cap that could be used. Where your income is at a level that allows you to contribute more to super, you may benefit from tax savings. Let's take a look at an example. Let's take Ken, who is 60 and earns $100,000 a year. He intends to keep working full-time for another 5 years and has $300,000 in super. His employer contributes 11.5% or $11,500 into super for the 2024 to 2025 year. So Ken decides to salary sacrifice $18,500 into super to take advantage of the $30,000 concessional contribution cap. Ken's take-home pay reduces from $79,212 to $66,262 as a result of his salary sacrifice. Ken needs to maintain the same income to meet his living expenses, so he starts a TTR pension by transferring $129,500 to an account-based pension and withdraws the maximum allowed of 10% or $12,950. So the tax paid by Ken before commencing a TTR pension is $20,788. The tax paid after commencing a TTR pension reduces to $15,238. The tax paid on his salary sacrifice contribution inside of super is $2,775. His total tax savings equate to $2,775. His take-home income remains unchanged and he now has an extra $2,775 in super representing the tax savings for the current year. Over 5 years, Ken would save $13,875 in tax and boost his super by the same amount. This does not take into account the compound earnings on the extra savings made within super over the 5 years. Let's look at a situation where Ken needs $50,000 from his superannuation to fund some one-off event. Ken can only access a maximum of 10% of his super balance of $300,000 by using a TTR pension. He can elect to draw the amount as an annual payment, which is tax-free. Once he has drawn the nominated amount from his TTR pension, he is allowed to roll the TTR pension back into super and commence a new TTR pension with the same limits applying. Let's look at an example. On the 1st July 2024, Ken commences a TTR pension with $290,000 from his super fund. He nominates the maximum 10% or $29,000 as an income and elects to draw this immediately, or in July 2024. Having met the requirements of drawing the nominated amount, Ken can now elect to transfer the TTR pension back into super. His super fund balance is now $271,000, not taking into account any other transactions like fees, investment earnings, or employer contributions. Ken commences a new TTR pension in August 2024 and transfers $210,000 from his super fund and nominates the maximum 10% or $21,000 as an annual drawdown, which is again tax-free. Ken has achieved his objective of accessing $50,000 from his super. He is free to roll the TTR pension back to super if he chooses, or retain the TTR pension where he will be required to withdraw 10% again in the 2025-26 year. Always check with your super fund on the processing time needed to commence and roll back a TTR pension, as this will impact the timing of the total withdrawals needed. I hope you enjoyed this video on how to use a TTR pension. If you have any comments, please leave them below and subscribe to our channel if you would like to keep updated with new videos when we release them. The information and case studies provided in this video are for educational purposes only and not intended as personal advice. If you intend implementing any of the strategies outlined in this video, it's important you do your own research and seek personal advice. Changes to legislation and all examples used in this video will change over time, so it's important you check any examples used in this video against the current situation. Thanks for watching.